What's good, guys? In this video, we're going to cover fair value gaps. There's a couple different terms that you could use for fair value gaps. You could use imbalance, you could use inefficiency, and this is another one of those things that you're going to want to wait for your other confluences in order to take a trade, okay? So, you have your fair value gaps, and essentially what a fair value gap is an area in price where there was an uneven distribution between buyers and sellers. And if we were just really quickly to look at price right here, guys, I'm just going to show you guys conceptually what it looks like, and then I'm actually going to explain and break it down. So, it's a 3-candle sequence where you can tell that there was uneven buying and selling. So, for example, let's look right here. You have a candle, bullish candle, bullish candle, bullish candle. However, candle 1, candle 2, candle 3. Remember, it's a 3-candle sequence. And a fair value gap is when the first candle and the third candle of that sequence, with their wicks included, don't overlap fully the middle candle. So, for example, boom, boom. If we mark these, that leaves a fair value gap right in here. And you'll notice this play out. You'll notice these fair value gaps and imbalances on every time frame all the time. And this is why you can't just trade off of them blindly. You want to have other confluences with your trade, because if you were just looking at every single fair value gap, you'll notice that some of them or a lot of them are not playing out, and that's probably because there's no other confluence with that trade. But again, the market is only ever looking to do one of two things: sweep liquidity and rebalance price. Okay, so that is why you will see this being very accurate, however, if you do have confluence with your trade. For example, here's another fair value gap. Candle 1, candle 2, candle 3. You mark from this wick to this wick. If you were to use a rectangle or a box like this, you'll see how price, even though it wanted to push up and grab this liquidity, how price comes up, but it comes back down in first to fill this fair value gap. It doesn't have to fill it fully, right? But it filled the majority of this gap and then pushed the rest of the way up to sweep this buy side liquidity that was resting up here, which it also did during that macro time, okay? So this is the same example that we were using for our break of structure. So let's actually do this, guys. Let's go ahead and drop down to the 1-minute time frame. Okay, let's go ahead and delete this line, clear this up, and let's go ahead and just jump into bar replay mode, because why not, right? So here's what we have, guys. We have a sweep of liquidity, right? So we have this sweep of liquidity that just happened right here, and now we're watching price here on the 1-minute time frame. Let's pretend that you were trading the S&P 500 at the beginning of PM session, and you start to see this happen. You know that we have this sweep of liquidity, right? You already can see now on the 1-minute time frame that we've gotten the break of structure, right? Obviously, we have the benefit of hindsight, knowing what already happened on the 5-minute time frame, that this was also a 5-minute break of structure after the liquidity sweep. So we've got all of these things as confluence. And now on the 1-minute time frame, we can see what? We can see with this 3-candle sequence, candle 1, candle 2, candle 3, an obvious fair value gap, an obvious imbalance in price. So even if price wants to just keep, selling off and continuing lower, I want you guys to think of these candlesticks when they're printing out. I want you to think of it like watching somebody paint a wall. And if you guys have ever painted anything before, you guys know what I'm talking about. Like if you have a roller, and if you just do one little roll up that wall, there's going to be little pores on the wall that didn't fully get filled in. So what do? You bring the roller back down a couple swipes in order to make sure that it's all filled in. And then once it's all filled in, that's when you can move on to the next section of the wall that you're painting. Kind of a funny analogy, but I think it's one of the most simple ways to understand this, because in a way, this was that paint swiping down the wall, and up in this fair value gap are pores or little pockets that need to get filled in, or orders that weren't able to get filled. So therefore, at some point in time, price, we can expect to come back up and fill in this inefficiency in price, this fair value gap, this imbalance, again, whatever term you want to use for it. So we can actually anticipate that to happen at some point. So again, if you were to mark this up from the candle number 1 wick to the candle number 3 wick. In this case, there isn't a wick, but we just have a body, and this is our fair value gap. Okay, so the way that you would enter a trade off of this is to simply plan on entering either right when price enters that fair value gap, which is, I would say, the most common, or you could do the 50% if you wanted to be really precise, or maybe if the fair value gap was really large and you wanted to save a little bit of risk to reward. But let's just pretend that you were to enter right here, and you can do a couple different things with your stop loss. You can either put it above the 3rd candle in the sequence, which a lot of times will be the high or the low that ran liquidity, or in this case, since we're on the 1 minute, you could just tack on a little bit extra, go above the highs where the liquidity was swept. And then for your take profits, we'll get into this in a later part of the boot camp as well, but you would target essentially opposing liquidity, aka other lows, other highs, other fair value gaps, etc., so on and so forth, right? So we'll just draw this out no particular way. We'll actually just go ahead and delete this, and you guys can see how this plays out. So if we play this back out, boom, price comes into that fair value gap, actually came up to that 50%, it looks like right there, taps into it, fills it a couple times, and then sells off. So you guys can see how this all kind of unfolds, and as you're unpacking this and putting this all together, right, it didn't work by itself. But why did it work? It worked because we had, boom, a run on liquidity, aka fuel for the next move. We confirmed it then with a break of structure and a fair value gap. So this is an A-plus trade setup, and we're within those pockets of time that we started this entire thing off with. That's when these concepts are the most deadly and the most accurate, is when you can put them all together just like this, guys. So it's really cool to just see this all play out. And again, let's just, for good measure here, why not? There's another fair value gap right here, which actually got tapped into actually with this candle. But, we just watched this, boom, that respects and that holds as well. So you guys can see what I'm talking about when I'm talking about like that paint roller going down the wall, and how it has to come back and fill in these inefficiencies in price in order to just continue with wherever it was going to go anyway, guys. So that is what a fair value gap is. That's how to trade it. That's how to look at it. And that's how to identify it on the chart. Hopefully this helps, and I'll see you guys in the next one.